Hello, everybody. It's November 7th. It's Monday, and here we are on the way to the holidays next week. I think next week, maybe. Well, let's put it this way: the next few weeks we're going to have Thanksgiving, and Christmas, and New Year's, and Hanukkah, and all that wonderful stuff. So I think we're all probably starting to get into the festive mood. Stock market hasn't been so festive, but we still think has a chance of having a Santa Claus rally. It's possible we already had our Santa Claus rally during the summer and early fall, but we'll see how that plays out. I know some of you may be disappointed that Max isn't here. It's I don't know how to break this to you, but it's hard to get Max over here when he smells chicken cooking in the kitchen. He knows that's going to be his dinner for the next few days. So the smell of chicken, which I can smell, but you can't, is pretty powerful here. And so we can't compete. And so Max is going to stay where he is. Also, today is Monday. Usually my gardener comes on Fridays, but he's here today. So we may have some leaf blowing noise in the background, but that's okay. It's that time of the year. Well, let's talk about some things here. Lots to talk about, actually. We addressed the question of earnings in the morning briefing today. On Saturday, we took a look at in our market call piece that we sent you in Quick Takes. We looked at sort of this risk-off situation that we have right now, and I think we're seeing that. Well, we saw it last Thursday, of course, in the market, which had a big down day. But we also saw that Bitcoin went down, gold went down, all the exciting stuff got hit. There's actually a meme ETF, and that was also down. So we're watching these risk-off developments. I think that's a good thing. I don't want a melt up. I don't want this market to go straight up. And I've been opposed to Fed easing really over the past 150 basis points over the past year because I thought that the economy really didn't need lower interest rates, that the interest rates are actually at neutral. They are where they should be. And I felt that by providing the Fed put here, just in case the labor market needs it when inflation's still above the Fed's 2% target, I felt that could fuel a melt-up situation. And I think we got a taste of it over the past couple of months. And now that the market has sort of given up hope of 100% drop in the Fed funds rate on December 10th when the FOMC meets. Now, the latest expectations that I saw was about a 44% expectations that the Fed will cut the Fed funds rate on December 10th. Look, I'm kind of surprised that the market apparently sold off last week because a few Fed officials, I call them the Federal Open Mouth Committee, decided to basically endorse what Chairman Powell said in the press conference a few weeks ago. In his press conference, he said that there's no guarantee here whatsoever that we're going to have another rate cut in December. He was pretty explicit about it. So I kind of view the last rate cut back in October as a hawkish rate cut. Nothing to get particularly excited about if the Fed was going to go back on pause mode. And so the market seemed to come to terms with that last week. And that was one of the explanations for why the market had a bad week, particularly on Thursday after Fed officials said what they said about inflation still being higher than target and that they've already cut rates quite a bit. Kind of repeating what Powell had already said. In addition to that, we've got this kind of huge debate about accounting, about depreciation, and whether the hyperscalers are taking their sweet time in depreciating their NVIDIA chips, taking 5 to 6 years to do that instead of 2 to 3 years. And so that seems to be the big debate. And obviously, if they're taking their sweet time and that's goosing up earnings, then that raises the question of the quality of earnings, particularly coming from these hyperscalers, and they've been hyper active in producing some amazingly strong earnings. And if they're actually doing it right, look, I mean these chips, even if they get depreciated over 2 to 3 years, their useful life doesn't just kind of suddenly end. They do use the chips, which are no longer state of the art, in meeting demands for maybe uh, computing demands by users that just don't need as much computing power as the people who are running the large language models, for example, which apparently take up an enormous amount of the computing power and energy power of the data centers. These data centers haven't just popped up over the past year or so. These data centers have been being built for what, 5, 6, 7 years? Actually, more than that, because we went on the Amazon cloud in 2011, and I think that was all in data centers. So there's a lot of data centers out there with probably chips that have already been written off that are still operating. So I think that's something to keep in mind in this debate. Is it's not as though an NVIDIA chip suddenly becomes useless after 2 to 3 years. It could very well have a useful life of 5 to 6 years. And then when it's no longer useful, then you can replace it with the state-of-the-art chips, I suppose. Anyways, this is a really a known unknown. Nobody really knows the answer. So maybe the uncertainty of all that will kind of slow this bull market down for a little while here, and maybe we won't get our Santa Claus rally. Maybe we'll just consolidate. But I don't really expect much of a more of a correction than we've had. We are retesting the 50-day moving average of the S&P 500. I'm not going to rule out the possibility that that fails and we go down closer to 200-day moving average. But the earnings story is extremely powerful. Um, Again, you probably could raise the issue of the quality of earnings, but it looks like the earnings story is pretty powerful across the board, not just for the hyperscalers, but for lots of other companies as well. And that in turn confirms in my mind that if earnings are resilient, then the economy must be resilient. And we should, in the next few weeks, get some indicators that kind of confirm that. We might have gotten one this morning. The New York State, the New York Federal Reserve does its business survey, and the one for November just came out, and it was actually quite strong. But it's a very volatile series, so I wouldn't want to hang my hat on that hook that was just established in November. Let's mosey on down and have a look at some charts. And let's see here. Let's share because we care. Okay, so uh, I don't know what I want to start out with. Actually, I want to start out. Let's start out with the happy news from New York today. This all these charts are automatically updated on our charts portion of the website. My son David Yardeni is our data manager, and if you ever need any chart books that are automatically updated, let us know. David can whip these things out very quickly. But as you can see here, this one automatically updated a few minutes after the New York Fed data came out, and it was strong, but it's a volatile series. So again, I don't want to put too much emphasis on it, though I do like data that supports my story. Data that doesn't support my story is bad data or it's going to be revised. I've mentioned that to you before. New orders look okay, but again, relatively volatile. What else can we look at? How about prices paid, prices received? That's still kind of elevated. So that's certainly not signaling that we're going to get surprising drops in the inflation rate. And the inflation rate right now looks like it's kind of stuck around 3%, and it's stuck around 3%. It probably would have been at 2% if it wasn't for the tariffs. So I think over time we will see the inflation rate come down, and given that the administration, the Republicans, uh, got their butts kicked during the latest elections, though they were held in blue states. So having them turn bluer doesn't really come as much of a surprise. But the Mamdani win in New York on the affordability issue is a very simple issue to run on. And so the administration now is focusing on affordability. And that means they're lowering tariffs on food products. I mean, they're basically conceding that some of these tariffs, maybe all of the tariffs, have some impact on boosting inflation, or if not boosting it, keeping prices up. And they'd like to bring coffee prices down and other prices down. This is the quick takes that we sent out on Saturday. That's the market call, the weekly that we put out that tends to be a little bit more uh, action oriented with regards to what we're thinking about what to do in the markets. Here's the 50-day moving average, kind of still holding up. This is the bull bear ratios for investors' intelligence and for the AAII. The AII never really got all that bullish. On the other hand, the II got very bullish, and it's still quite bullish. Anything kind of over 3% is kind of bullish, suggesting not that you should be bullish, it's suggesting that there's too many bulls. And so I use it, everybody uses it as contrary indicator. When you get kind of declines like this is when you want to kind of buy, no matter how your stomach feels, how bad you feel. But when it goes over 3%, over three as a ratio, or four, you want to be mindful about the possibility of at least some pullback, maybe a correction, maybe even a bear market. But it's really better as a contrary indicator when it's under one uh, to buy, rather than as a contrary indicator to sell when it's over three to four. But you can look at other indicators like the percentage differential between where the S&P is and its 200-day moving average. And if you see that there are too many bulls, and you see that that's being reflected in a kind of a stretched market relative to its averages, that is something to be alert about. Now, I'm very happy to report, since I do tend to root for bull markets, I'm very happy to report that the Economist front cover this week had looked like this, and how markets could topple the economy. So again, the Economist front cover can often be used as a contrary indicator. So I view that as a sign that we shouldn't worry too much about the downside here. Uh, then maybe some of these risk on assets that are now risk off, maybe they're signaling that some of the froth is coming out of the risk on trades. But that doesn't mean that that's got to be bearish for the stock market. It could be bullish if people kind of get a little less frothy about some of these alternative kind of investments, like Bitcoin. I'm not for or against Bitcoin. I'm agnostic about it. I don't really have an opinion about it. I guess I do. I don't understand why it should go to 1 million or 1.5 million. Or I guess Kathy Wood recently revised her numbers to 1.2 million down the road. But keep in mind that this Genius Act that was passed, and anytime something's called a Genius Act, it kind of brings out my contrary indicators, anyways. And the Genius Act basically legitimized stablecoin, and stablecoin is exactly what it is. If it's a dollar stablecoin, it's backed by dollar liquid assets on a dollar for dollar basis, and to a large extent, it's backed by treasury bills. So if that's going to be successful, then the transactions use of Bitcoins suddenly isn't there. The transactions use of crypto is being uh, satisfied by the Genius Act. And wouldn't you know it, we're seeing some sell-off here in Bitcoin below its 200-day moving average. And you can see that Bitcoin has been driven up by some almost kind of quasi-political events. Wall Street decided that they could actually make money in Bitcoin, so why not embrace it? Trump was elected and he sort of sold himself as the crypto president. He talked about a Bitcoin reserve fund that might be established by the government. That gave us a little push. And now we've got the Genius Act, where administration officials are embracing it as a great way to create demand for treasury bills so that they can finance more of the deficit in treasury bills where yields tend to be lower with this need to back up a stable coin. And so that helps to take some of the pressure off of financing the deficit. Doesn't it also takes political pressure off of them to do something about the deficit? That's the downside. They also all of a sudden like the fact that it might be bullish for the dollar, which is odd because I thought administration officials were rooting for the dollar to go down. I know Steve Moran has been rooting for a weaker dollar. So he's actually said some good things about stablecoin and implied that it could be a stronger dollar. So there's a little confusion in my mind about which way they want to see the dollar going. Maybe that's because they're confused. And then let's not forget that we had this front cover story on Forbes about the Bitcoin alchemist, and that's Michael Saylor. And this is just a comparison of some other luminaries that made it. Maybe it does, just being on the front cover of Forbes doesn't guarantee that things are going to go against you. But then again, this is a strategy, the stock price MSTR. And once again, we added all these developments here. Bitcoin ETFs launched, so strategy goes up. Trump elected. The Forbes. Here's the Bitcoin Alchemist article right there. Trump talked about the reserve, so that sent strategy back up. And then the Genius Act passed, and the day before, we saw, at least for the year, a peak in MSTR, and now it's taken quite a dive. So it's always never a dull moment in our business. This is just the Magnificent Seven. They've also had a little bit of their comeuppance over the past few days, especially Meta. People kind of remember what happened when Zuckerberg embraced the metaverse. I don't know why he wants to remind us of that by renaming his company Meta, but the metaverse, I think he spent $10 billion on and then realized that it was a waste of time and a waste of money. And now there's a concern here that he's doing the same thing, perhaps with AI, but we'll see. We're open-minded on the AI trade. It has had a big move. Let's look at earnings. This is the really exciting story, in my opinion. Earnings drive the economy, and the economy drives earnings. Here's corporate profits and GDP after tax in billions of dollars from current production. So it's kind of cash flow corporate profits. Obviously, the trends are very similar. There's some signs that even the cycles can coincide, and that's between payroll employment and corporate profits. Obviously, profitable companies expand and hire. Maybe that's not so obvious anymore. Profitable companies seem to be increasing their margins partly by not hiring. So maybe something is changing here in the dynamics of the economy. And we think what's changing is there's a shortage of the kind of labor, the skills that companies need, and they are using technology to increase their productivity and augment the productivity of their current workforce. So they're not massively laying off people, notwithstanding what Challenger is showing. Challenger is showing layoffs mostly in technology, some in warehousing, which is probably the UPS situation, but that can change pretty rapidly, especially as the holidays approach. This is capital spending versus corporate profits. So that certainly the trend's similar, and the cycle is even more. Again, profitable companies expand not just labor force but also capacity. This is private non-residential fixed investment capital spending, this time in nominal GDP versus corporate cash flow. And corporate cash flow, the more corporate cash you have, the more the trends are right for capital spending. Obviously, if you spend all your corporate cash flow on capital spending, you wouldn't see this here. So there's plenty of capital spending going on, a record high with a record high in corporate cash flow. I think that's important to consider when we're looking at some of these questions about whether companies are spending too much on capex and not and eating into their cash flow. This is corporate profits versus nominal gross domestic product. So again, those are kind of four charts that just show the relationship between the economy and profits. Okay, so we already looked at that chart. Here's the really exciting stuff. This is the level of earnings expectations, consensus analyst expectations, and here's those earnings hooks in the first quarter, second quarter, and now the third quarter. Notice how the analysts got concerned about Trump's tariffs and that they weren't getting much guidance from companies, so they lowered their numbers and then turned out to be better. Same thing here. They lowered their numbers and then turned out to be better. This time they got it. They weren't going to lower their numbers as much, and yet we still had this big surge, and now we're over what they expect for the fourth quarter. And the fourth quarter is usually the strongest quarter of the year. Here's what it looks like in terms of growth figures. So you can see that in the first quarter, before the earnings season started, they expected about 6%. It came in at basically 12%, so double the growth rate. Look at this growth rate in the second quarter. It was like I think a little over 3.5%. Came in at 10%, so basically more than another double. And then here we go from 6.5%. This time they weren't as pessimistic coming into the quarter, but then the actual numbers are going again more than double. We're talking about over 14%. So earnings have been fabulous. And keep in mind, this is all occurring with Doge and with tariffs and all the volatility out there, the uncertainty about what the economy is doing. But forward earnings are hot as can be. As you can see, all-time record high. We're converging towards the 2026 consensus expectations. That's pretty powerful. We don't really care about 2025 anymore. We only care about the fourth quarter to the extent that it influences analyst expectations for next year. But right now, they're actually getting more excited about next year, and we're converging to that. We thought that by the end of the year, we'd be discounting $300 a share for next year. Well, the analysts are already, the consensus is already over that at $308 a share. So we will probably see $310 a share here as the analyst consensus, and that's what forward earnings is likely to do. Forward earnings, great coincident, even leading indicator of actual quarterly operating earnings multiplied by 4. All-time record high is what we're like. Well, we actually had third quarter data come out, and so on a 4-quarter basis, we're at all-time record high. I'm sorry, quarterly annualized. So that's quarterly times 4. Look at this. This is we didn't have a lot of data on the economy, but we had forward earnings, and forward earnings is quite highly correlated with the index of coincident economic indicators. And again, this looks pretty powerful. So maybe the economy is doing better, though. Again, the controversy is quality of earnings, perhaps. Meanwhile, speaking of earnings, as we are, this is revenues and earnings. It's sort of a breadth measure. Percent of S&P 500 companies with positive 3-month percent changes in forward revenues. And you can see we've had quite a pickup here. So I think that kind of belies the notion that all of the strength in earnings has been just among 7 companies that have been kind of creating some magic or or kind of doctoring the strength of their earnings. Well, here's the S&P 500 forward earnings. Again, another shot, the same thing we've just been looking at, shooting up here. This is in billions of dollars because we want to compare it to X Magnificent Seven, so we can't do it per share. And you can see that excluding the Magnificent Seven, we are still at a record high and doing quite well. So it's not all a Magnificent Seven story. This is the Magnificent Seven, so their earnings have been very strong. So we do now have third quarter numbers. You can see them in this chart, all-time record high for earnings per share, for actual revenues per share. Did I get that right? Yeah, this is the revenues per share, this earnings per share. And look at the profit margin. I mean, not much of a dip here in the face of Doge and Trump's tariff turmoil. Growth rates pretty good. Revenues 5.8%. That's pretty solid, kind of consistent with the average historically. Look at the operating earnings growth rate, very strong at 14.9%. So that's great. Here's another picture of the margin, also showing you the forward profit margin, which is they're both at or just slightly above their record highs. So the question, though, when you look at forward earnings by the sectors, here's the one that clearly stands out. So there's no doubt that technology's forward earnings are what's leading forward earnings higher. This is high to low, so you got the information technology is here. This is the overall S&P 500, and this is technology. And then you can see everything else looks not so exciting by comparison, though. This is forward earnings. So interestingly, healthcare is second, but that's that we're looking at the kind of the slope. Anyways, have a look at it on your own. Let me take a few questions here on the Q&A. I have one so far. Can you review your take on small cap going forward? Yeah, I mean, I'd like to tell you the small cap are cheap relative to large cap because they are. We have seen Russell 2000 a few weeks ago go to a new record high, and the Russell 2000 has actually outperformed the S&P 600, which is small caps for the S&P 600, because there's been more risk on. When you see Russell doing better than the S&P, Russell 2000 doing better than the S&P 600, kind of raises a flag that there is a risk on trade, because a lot of the Russell, I think something like 30-40%, maybe some of you can correct me, but significant percentage of Russell are companies that earn no money. They might have tremendous stories behind them, but they are story stocks, whereas the S&P 600 tends to have lots of companies that are profitable. But it's been frustrating. They just haven't done much. S&P 600 is got a very small market cap relative to the S&P 500. And I think the problem in the small caps is forward earnings have been kind of flat. Oh, there's the Gardner. The S&P 600 have been kind of flat since 2022, and the reason they've been flat, I think, is because it's hard to have winners stay in there for very long because they get bought out by the large cap companies that see an opportunity in a small cap to leverage it up within their own organizations. So we're trying to keep an open mind there, but it's the performance has been frustrating. Any thoughts on the U.S. dollar? Yeah, I mean, I've been a contrarian saying that the weakness in the dollar this year is a correction. A lot of people look at the DXY, and I've been pointing out that the DXY has got a lot of issues. Not a lot of issues. The main issue is it's a fixed weight index with 57% of it attributable to the 57% of it attributable to the euro. It's not a trade weighted index at all. So you might as well just look at the euro versus the dollar. And what's so exciting about the euro? Uh, I'm positive on the dollar, especially now with stablecoin. I kind of just became an overnight expert on it. Read quite a bit about it. Let me just hang this up. Read quite a bit about it. Wrote a piece on stablecoin last Monday, and I think it's from what I understand, it's already taking off big time in emerging market economies that don't have much of in the way of a financial system, and stablecoin is kind of becoming their currency. Uh, how does gold looking forward? Well, you know my story. I've acknowledged that I know nothing about gold, that I've never had an opinion on gold, and yet I suddenly came out of the blue and had an opinion when it crossed 2,000 last year. I said this looks like a breakout to a new high, and it might be the beginning of a more bull market. And the reason for that is because the the freezing of Russian assets by the U.S. and Europe of their central bank assets. So suddenly central bankers are accumulating gold. I didn't establish any upside, but when I got to 3,000 at the beginning of this year, I looked at the charts because what else can I do? And given my limited understanding of the gold market, other than to project that I could get to 4,000 by the end of the year, well, that worked out pretty well. And when I got above 4,000, I said I think it's going to consolidate until the middle of next year around this level, and so far so good. But then next year 5,000. And then I stumbled upon a chart that is kind of cool, and that is the S&P 500 versus the price of gold. Let me see if we can share that real quickly here. Um, yeah, so let's see here. Where do we want to go? Oh, here we go. So we go to our charts. This is also a good way for you to see our handy dandy charts. This is the chart room. So we got something called Roaring 2020s and 2030s. And right at the end, by the magic of all this technology, look at that. Isn't that an interesting chart? I think so. I mean, this is gold was cut loose from the gold window. It was no longer pegged by the U.S. Back here in the early 70s. So this is the price of gold in dollars per ounce, and this is the S&P 500 on exactly the same scale, and both of them on a ratio scale, and they do seem to be inversely correlated. So that suggests that gold is actually a pretty good diversifier in an S&P 500 portfolio. And at the same time, the trends kind of look very similar. So if we do have a fundamental story to tell about the S&P 500, we do think it's going to 10,000 by the end of the decade, which is the end of 1920 of 2029. I don't want to bring back 1929. I don't think we're going to have that this time around, but I'm open to the possibility. And then gold, in that case, gold could get to 10,000. So that's my happy story on gold. And I hope you like my happy stories. I'm aware of all the things that could go wrong, as is everybody else. There's been a lot of pessimism, a lot of talk about bubbles bursting, and that gives me confidence that we might be okay for a while. Anyways, let me see what I can do here. Okay, that'll do the trick for me. Thank you all very, very much.